Welcome to everybody, and thank you for joining us. I am Don Chambers, Chief Investment Officer of Biltmore Capital Advisors, and today I want to talk about the asset allocation decision process that we use at Biltmore Capital, and that refers to how we select the asset classes and how much weight we give to them. Is it 80% stocks or 30% stocks? It's a very important issue, and it's an issue that I love talking about because there are clear answers that we can come up with to these decisions. And I hope that my seminar today, the webinar today, is clear. If after I've talked you have questions, of course, as Brad invited, you can send them in. But you should be able to get clear answers to these types of questions. They're so important. If I haven't been clear, please contact me or contact Tyler or Tim or Justin or Richard or somebody at Biltmore Capital to get clarifications. This is the first of two webinars. Eventually, we'll have a webinar on the other side of it. This is the big picture asset allocation decision. The other side of that is the security selection or bottom-up decision, and we'll be talking about that in a future webinar. I'm really proud of the asset allocation decision at Biltmore Capital, and so I've really been looking forward to doing this, and I hope you ask some questions. The number one issue that we need to decide in a portfolio is how much risk to bear. And so that we pictured here the battle between risk and reward. And I want to talk about that along two dimensions right now. On the left side, there's two sentences to the bottom. And it's taking a little bit different view. For just a moment, I want to talk about it. And that is the role of risk bearing in a society or in a modern economy. That an economy such as the United States or most other major economies in the world require tremendous amounts of capital. And that capital is being placed at substantial risk. So risk bearing is an important contribution to society. That when I've lectured for years to students and talked about the idea that we know that it takes steel and concrete and glass and workers to build a building. But what's kind of hidden behind that is that in order for that building to exist, somebody had to provide the capital and take the risk. So when we invest our money and bear risk, we should view ourselves as doing one of the most important things that underlies productivity and the foundation to an economy. Of course, we're more often looking at the right-hand side of this idea, which is what's it going to accomplish for us in our portfolios and in our attempt perhaps to have a pleasant retirement. So the condition that we find ourselves in now, we've been in for the past 10 years, and I think we're going to be in for quite a long time to come, is that if we don't take any risks at all, we're not going to be able to keep up with inflation on an after-tax basis. In other words, if we put our money in short-term CDs and money market accounts, the tiny interest rate that we will earn once we've paid taxes won't even keep up with inflation. So we need to bear risk to have positive, good chances at positive after-tax real returns. And that's what this is all about, is deciding how much risk to bear and where to bear those risks. The decision of which asset classes to invest in, stocks or bonds and alternatives, and which percentage to put into each of those is often referred to as the top-down decision. And that's a top-down emphasis is when that's what guides most of the portfolio selection. That decision is the biggest single driver of investment portfolios returns. So it's a really important decision, and I want to make it clear how we make that decision at Biltmore Capital today. When I talk about asset classes, it can be confusing because it means different things to different applications. At the broadest level, especially for purposes of Biltmore Capital, we talk about three major asset classes: stocks, bonds, and alternative assets. A lot of people will throw cash in there. When we say cash, we mean short-term money market securities. We don't think that's a good asset class to be using nowadays. Obviously, we need to have a little bit for liquidity, but some people throw that into bonds, but we don't really invest substantial amounts of money in short-term money market sorts of securities. So our three major asset classes are stocks or equities, bonds or fixed income assets, and then alternative investments. But we do get less general, more specific, and we start to break stocks into domestic and internationals, and bonds into government and corporate and high yield bonds, et cetera, and so forth. And we even get more fine when we get down to domestic stocks. We can look at large growth stocks, large value stocks, mid-cap growth, mid-cap value. So we can get a lot more specific. For the purposes of today's discussions, we're talking mostly at that general level of stocks, bonds, and alternatives. I like to think about buckets when I think about risk, and a bucket is just a visual for us to think about how much risk we're bearing. And the most important decision that we face is the total amount of risk that we're going to bear. So I like to think about it as a bucket, and the question is, how much risk are you going to put into the bucket? If you don't put any risk in there, you're not going to get an attractive return, in my opinion. So the question is, how much risk is it appropriate for us to bear? Well, how do we make that decision? How do we help work with our clients to make the decision of how much total risk to bear? Well, I'll get to that in just a moment, but what we do is we have 5 primary model portfolios. A model portfolio is a target set of weights. So for instance, a portfolio might be 50% stocks, 30% bonds, 15% alternatives, and 5% cash. Now we don't put 5% in cash, but this would be an example of a model portfolio that a firm might offer. I believe Morningstar offers that in one of their portfolios. So we have 5 of those models, and those 5 models are designed by Biltmore to be appropriate for 5 types of investors who have long-term investment horizons. We're not talking about managing a large pool of cash or something like that. We're talking about people who are interested in preparing for long-term futures such as retirement. Our 5 model portfolios vary. On the left-hand side, aggressive is the person who tolerates the most risk, through moderately aggressive to more middle-type investors who are more balanced in their risk-taking, to conservative or even very conservative. And when we refer to very conservative, we're referring to very conservative investors who are somewhat long-term. They're not somebody who's saving up cash to buy a house in 1 year. They would be very conservative, but that's different from somebody who's very conservative when they're planning for retirement. So certainly we think that even a very conservative portfolio, a very conservative investor when planning for retirement into the distant future should have some equities in their portfolio. We also have 2 taxable categories, qualified or retirement funds, and then taxable accounts. And those portfolio models are different. They're primarily different because of municipal bonds. We want to put municipal bonds in retirement in taxable accounts, and we don't want to put municipals as a general rule in retirement accounts. So that's the primary reason, but it actually leads to 10 models. The model that we pick from aggressive to very conservative with the client should be based upon the investor's current financial circumstances, their time horizon, how long before they anticipate pulling out money, anticipated major financial changes such as retirement or children going to college, what their goals are, how the lifestyle they aspire to in their retirement, their experience in investments, and their degree of financial sophistication. How do we assess those things? Well, we do that with sitting down with our clients and really getting to know them and know these issues and their experiences and what their goals are. We also use a survey. This is a survey produced by Morningstar. And you can see as you go through this a little bit, the first few questions are about time horizon. Time horizon is very important in deciding how much risk to bear, how much, which assets to put a client into, what are their long-term goals and expectations, and how one might think about performance in the long term. And then the bottom category here is short-term attitudes towards risks. How well would you tolerate a loss that occurred for just months or a few years as opposed to long term? This survey helps guide us to a level of risk in terms of the model. Or to go back to the bucket approach, it gives us the answer to the question of how much total risk to bear. Now we can quantify this. I like to think of it this way, that if you were to talk with a client, if you were to think about this, and you were asked if the stock market were to gyrate up and down by 10% over some period of time, how, nobody enjoys risk, but what level of risk could you tolerate? An aggressive investor might answer that, well, if the stock market goes up and down 10%, well, I'd be happy to just go up and down 9%. That's a pretty aggressive investor. They're willing to basically subject almost all of their funds to the risk of the stock market. A moderate investor might say, well, I wouldn't want to go, and nobody wants to bear this risk. They're just doing it to get return. But a moderate investor might say, well, I guess to get higher return, I'd be willing to lose half as much as the market, or maybe just a little bit more. And a very conservative investor from a retirement perspective would say, well, if the stock market, were to drop 10%, I wouldn't be comfortable with a portfolio that would drop much more than 2%. To me, this is really, it cuts to the heart of the issue. If you think about this, is when the stock market gyrates, as it always does, although lately it hasn't done it much, when the stock market takes a big dip like it did in 2008 and it drops 20 or 30%, what portion of that could you tolerate? What portion do you want to tolerate in the pursuit of higher long-term returns? So I hope that's helpful for you to think about where you should be in regard to these 5 models. So we use, as I just talked about, a questionnaire, discussions, and analysis, talking with the client a great deal to put each client into one of 5 portfolio models ranked from very conservative to aggressive. But this is not a set it and forget it decision, by the way. I think one of the advantages of being with a registered investment advisor like Biltmore is that we stay in contact with the client. We want to know about changes that are occurring in the client's goals and circumstances, such as impending retirement or job changes. So one dynamic process is understanding what's going on in the client's life. The other thing to think about is what's going on in the financial markets. And as financial markets change, as interest rate levels and equity values change, should the portfolio be changed to pick up better risk return opportunities in light of new economic circumstances? So as I said, it's not a set it and forget it decision. It's something that we should be regularly reviewing based on client circumstances and financial market conditions. Now this slide right here is probably the most sophisticated, if I will, view of financial markets, and it's going to take a little explaining, but it really cuts through to how I and our investment committee at Biltmore views risk-taking. If we focus down on this left-hand, the bottom half of the slide, our total risk, the big bucket on the left, is going to be the sum of a number of individual types of risk. And I got them ranked kind of from starting with the biggest. And the biggest risk that we take in the normal portfolio is the risk of equity market fluctuations. And that could be primarily the U.S. market, but also international equity markets. That's the biggest risk that we take. And it's the risk that history and theoretical reasoning tells us is the most important risk, and the risk that has been, and we believe will continue to be, best rewarded in the long run. So what I'm getting at here is we want to fill up our total risk bucket with the right level of risk. But the question is, what risk types should we pick in order to fill that bucket? And what I'm saying is that even though I made all these little buckets the same size, it's the equity risk bucket that tends to hold the most risk. That's where we want to take most of our risks. People investing over the past decades or even centuries have primarily accumulated wealth through long-term returns by investing in equities. That tends to be the best, for lack of a better word, bet as to how to earn higher returns while taking risk. Interest rate risk is another important risk. How long maturity do we want for our bonds? Do we want them to be fixed rate or floating rate? It's an important bucket, but it's nowhere near as important as the equity bucket. Very little added return is received by taking interest rate risk beyond a 1-year horizon. So we certainly pay a penalty if we invest in money market securities. But if we start to get out to at least 1 to 2 years of investment horizon, bond maturity, that seems to be where we pick up most of our return by just going out that first year or two. Credit risk is primarily in the bond category, and that's investing in bonds that could default. They're not AAA rated. They're not U.S. government guaranteed. That's a bucket in which we want to take some risk. I'd like to just skip over illiquidity right now and just get to the skill-based, and there are others, by the way. I just illustrated this with 5. Skill-based relates to the alternative investments category. It's this idea of investing in strategies that are whose added return is going to come from an ability to select underpriced investments, and that we also think can contribute to returns. So to me, the portfolio management goal is to put the risk into the best buckets in a combination that is well diversified. That's the key. Biltmore is a highly diversified investor, and what I'm illustrating here is we diversify across different types of risk. We just don't put all of the risk into the equity bucket or all into the interest rate risk bucket. We're trying to diversify. And when I do the next webinar on security selection, you're going to find that even within these categories, we are a tremendously diversified registered investment advisor. And the reason is because diversification is a free lunch. You can lower your risk without lowering your expected return. This chart is not meant to be taken too literally, but it's suggestive of the way that we look at things. When we look at an asset category, which is on the left-hand side, it exposes, across the top, it exposes us to different types of risk. So if you look at the stocks, it primarily is exposed to equity risk and to a lesser extent liquidity risk. When we look at bonds, they move with the stock market, but they also move with interest rates and credits. And if we flip, and money markets don't move with any of those risks, that's short-term cash. And then over to the right, alternative assets. Some of our alternative assets do move with the equity markets, such as real estate and MLPs. But the skill risk is the primary risk bucket we try to pick up in our alternative assets category. So what we're trying to do is diversify, number one. And number two, we're trying to find the asset class weightings which will best take advantage of the prevailing risk-return trade-offs. Now, I'll just give one example. A number of months ago, we moved in the direction of taking less interest rate risk and more credit risk. Once again, we don't like taking risks. We only take risks to try to grab added return. And it's been our view for the past few months that interest rate risk is more dangerous now than it was over the past couple years. So we wanted to tone down the amount of interest rate risk and offset that by taking a little more credit risk. So how did we do that? Well, we moved from long-term bonds to floating rate bonds, shorter-term bonds. And we moved from into categories of bank loans, which we think have superior credit return opportunities. So we adjust our asset allocations to keep the risk buckets where we think the risk buckets ought to be. I hope that's conceptually clear. To summarize, Biltmore Capital has a top-down asset allocation decision. And when somebody says that they're a top-down asset allocator, what that really is saying is not just that they do top-down asset allocation, but that's the primary driver of investment performance. The opposite would be a bottom-up asset allocator. A bottom-up asset allocator picks a portfolio based primarily on which individual securities they think are attractive. So you could run into some investment professionals who will be saying, oh, put a ton of your money in Tesla or something like that. Well, that's a bottom-up asset allocator. We're a top-down asset allocator. A primary determinant of performance for all portfolios is asset class, and we want to pick most of the investments in the portfolio based upon portfolio asset classes. How do we come up with the asset allocation? Well, in the left box, we have the investor's goals and circumstances. We need to understand and work with you to understand the appropriate level of risk that we should be taking. And on the right-hand side, we monitor the markets and the risk-return trade-offs that we believe are available. And we put those things together to come up with the asset allocation in each of our models. And that summarizes the process that we use at Biltmore Capital.